You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we are in the heart of earnings season, specifically in the heart of Nasdaq earnings season. We're taping Options Playbook Radio right now. It is currently Wednesday, the 29th of July. The markets are closed. We did have eBay announce earnings yesterday, and that was the trade that we were looking at last week. We actually looked at a reasonable way to try to buy a call option going into earnings. So I'll start by summarizing that trade in particular, but we have a huge event that's going to be happening on Thursday after the close in Facebook, Amazon, Apple, and Google. And I should let you know that Facebook was actually supposed to be announcing earnings as of today, but we just saw a news headline pop up because of what's going on in Washington and all the CEOs of all these major companies meeting up with Congress and being questioned. They decided to delay it one day, which happens very rarely. That also means that we have I guess you can almost call it a quadruple witching this Friday in the Nasdaq, in that all of the major Nasdaq FAANG stocks, Facebook, Amazon, Apple, Google, i.e. Alphabet, are going to be announcing after the close this Thursday, and there's going to be option contracts that have exactly 1 day to live after those announcements, 1 day's worth of trading. So it's going to make for a fairly volatile marketplace as far as the Nasdaq in general is concerned, and we're going to just talk a little bit about how we might approach it, considering we're going to have this. I think it's the first time ever that all of them have announced specifically on a Thursday before a Friday weekly expiration date. So should be interesting. And to start with, let's go back to eBay. Let's talk a little bit about the trade from last week. Last week, that trade in general, it's always meant to be a paper trade. We're just trying to learn, specifically when we're talking about calendar trades, or in this instance, it was actually a diagonal trade where we have one option contract that we're trading that expires before the other option contract. So we did a diagonal. We were trying to sell some time premium that would afford us the ability to get long a call option at a lower price, at a lower cost basis, if you will, before that earnings announcement. So it was a speculative trade, to say the least. And so when we put on the trade, the screen capture that I have from the day that we were looking at that trade, eBay last traded on July 22nd when we were taping Options Playbook Radio, and it traded at 56.31. It was down 29 cents on the day. We were talking about selling the July 24th expiration, the nearest term expiration, at the 57 strike, and that was a call option. That was trading for around, I'm going to say midpoint 47 cents. Remember, the market was rolling at that time, so we didn't quite have it was a very active trade overall. And then we were looking to buy the 31 strike expiration, and now that went out past the earnings announcement. That option contract still has life in it because here we are taping on the 29th, so we have 2 full days of trading left in that option contract. And that was the 52 strike call. We went a little bit in the money. That was trading right at $5 on the midpoint. The entire net trade was done for a net debit of $4.53. Now, once that trade was placed on, one of the things that we talked about a lot was, well, we wouldn't mind if the stock went up to 57. It was at 56.31 and went up a little bit to the upside by that Friday expiration. But ideally, we were trying to capture that 47 cents from that 57 call. That was our real main goal. We wanted to be long that in the money call option going into earnings. Well, that did happen, but unfortunately the stock went down. And on the 24th, I just happened to be looking at that exact trade. It was July 24th around 11 o'clock. eBay did come down a little bit. And part of the reason why I captured the screenshot at midday on the 24th was that eBay was at 55.08, and I saw that the 57 strike call was trading for 0 bid, asking 2 cents. So if that was your goal, to get long a call option and have that 57 strike option contract go away, well, you could obviously have closed it for maybe a penny at that point in time if you wanted to, or you could have just waited until that expiration at the end of the day, and then you're just long an option contract. Now, you would have been down. The price of the 52 call was $3.95. You made 50 cents on the short option contract. You could have sold this for $3.95. So overall, you were looking at about a 50-cent loss on the trade, but you did capture all that time premium going into earnings. So what would I have done in that situation? I would have just rode the trade over the weekend, because the goal was to get into a longer call option going into earnings. But 2 points, let's look at it here, 55.08, and when we put on the trade, it's 56.31. So let's call it $1.20. It was down at that point in time. But the trade was working for us in that if we didn't sell that shorter term call against us, it would have been hurting us a lot more. The fact that we could get 50 cents for that call option, the 57 strike, 70 cents out of the money with only 2 days remaining to expiration, and it's not even in the earnings period, was a fairly decent premium overall. Okay, so what happened on the eBay trade? Well, eBay announced earnings, and I don't know if they were good or bad overall, but the market didn't think they were good. So eBay has been parabolic, so you would have had pretty good earnings for it to actually break out to the upside. And on the opening trade, the day after earnings on the 29th, which is today, actually, we saw that the stock opened around 55.19 and instantly traded lower down to 54.21. It actually ran all the way back up to 56 levels. So it was actually trading fairly close to where we put the underlying stock on, and that would have been the high print. I think that high print right there was, well, the high was 56.04, but it did not hang around there that long at all. And the market started coming back down to 54.53. So a very muted earnings for eBay overall, just not a ton of movement. It definitely didn't move as much as expected. And I think in this day and age, that's actually an anomaly to have an underlying stock actually move less than what the marketplace was expecting overall. So I thought I would take the time just to look at it. Now, just to close out this official paper trade, you have 2 full days of trading. You could hang around in the eBay trade, but we were doing it based off of the earnings. So, and ideally, if we stick to what we talked about on Options Playbook Radio, you would have gotten out of the trade. Probably would have gotten out about 10 or 11 o'clock Eastern time today when the stock was made a little bit of a rally to the upside. It would have taken that opportunity to get out of the trade. So at this point in time, the July 31st 52 strike call is trading for $2 and I'm going to call the midpoint $2.55, 248 on the bid, 267 on the ask. You would just close out the trade. You'd move on. You'd say, all right, I set the trade up all right. The market just didn't agree with what I was thinking. I probably would have got out a little bit earlier to try to see what I could salvage from the trade. But the net debit that you put on the trade for was $4.53. So it'd be down about $2 on the trade overall. And we would have had that profit on that short-term call, though, because it never did reach that strike of 57, and we were able to capture that 50 cents. And if we didn't have that, we would even be hurting a little bit more on this trade. All right, so let's move on to today's trade. And I'm going to basically just talk about some ideas around some of the gains that some people may have had in Apple, Facebook, Google, Amazon. If you own those stocks since obviously the March lows, but just overall, if you own those stocks, you're probably doing pretty well on them. The market in Amazon, I don't know if markets can go straight up, but Amazon has definitely attempted to go straight up ever since the downturn that was caused by the pandemic and the lows in March. So it's trading at all-time highs overall. And they're going to be announcing earnings. The implied volatility on a 30-day basis is trading right around 40% implied volatility. And we see that same with Facebook. Apple and Google on a 30-day basis aren't really that outrageous considering that we're going into earnings. They're trading at a 30% and a 28%. Now, I'm emphasizing a 30-day because I just wanted to compare them a little bit to what we're going to be looking at in the Nasdaq. And what I'm going to propose today, it's not meant to be a recommendation, it's just an idea. When you have these major stocks coming in, where is your concern? You have had some gains in these underlying stocks. The Nasdaq has definitely led the way to the upside. The Nasdaq has set new highs along with a lot of these stocks that we just mentioned, and they're all going to be announcing earnings after double-digit gains in the underlying stock. Percentage-wise, price-wise, I mean, Apple or Amazon has doubled. It was around $1,500 before the downturn in March, or at the downturn in March, and is now up over $3,000. So if we are thinking about that, my concern would really be to the downside. So what could we do? This is not meant to be a recommendation or a prediction or anything. I'm just talking about a concern. So ultimately, if we're looking to do a trade to try to protect yourself, if you happen to own 100 shares of Google or 100 shares of Amazon, it's a fairly expensive stock, obviously. So that's not a lot of. There's going to be a lot of people out there that are listening to Options Playbook Radio that own 30 shares of this underlying, or 50 shares, or 75 shares. There are going to be a few that own 100 shares of them. So you could go out and you could flat out buy puts as protection. And if you were going to do it on an individual stock basis, I would think about buying a put spread. In other words, buying something that's fairly close to where the underlying stock is at, and then selling an option contract 15% down or 10% down, something where you'd feel comfortable, where you don't think it's going to go much lower than that. And so a lot of times people shy away from just buying puts overall because of the overall cost. And so the first paper trade, if you will, or paper trade thought, if you will, would be to look at buying long put spreads purely as a protective play in some of these underlyings that have made such a big run up. Now, if you want to try to just go out and let's say we own all of those stocks, we just happen to own the FAANGs in general. Now, you probably, if you own a mutual fund, I don't know many mutual funds that don't at least have some exposures to these stocks overall, but I'm sure there are a few that are out there. But in general, if you have some exposure to these stocks, one thing that you can think about doing is just using the QQQs as a surrogate for those stocks, for those expensive stocks. So then the question becomes, and this is really the theme of today's trade, well, how many puts would I buy in the QQQ to try to protect myself against a downward movement in these underlying stocks? And there's a quick and very dirty, and I'm going to say that again, quick and very dirty way to look at it is just to think, if I buy one put, it represents 100 shares of the QQQ. The QQQ, as of now, with the markets closed, last traded at 259.77. Let's call it 260. So if you take 100, the multiplier, the number of shares that it represents, and times that by the last valuation, you're talking about $26,000 approximately of market value. Okay. And now, once again, I'm going to say this is just one way that you can kind of approximate how many puts you might be willing to buy. So the way that I would compare this, now you could go into greater detail and you could try to do something that's called beta weighting, and I'll let you go out and search for that term overall if you want to go into more detail, and it's a much more detailed way to look at it. And you would try to guesstimate, well, what's the beta on Alphabet and what is it on the QQQs, and I'm going to adjust it accordingly by doing a mathematical calculation to try to pick out the number of puts. Now, that's a lot of work, and you could do it if you'd like to, but what I would propose is just, if you're a little bit nervous and you've had some decent gains in these underlying stocks, maybe you spend a little bit to protect yourself against the downward movement in the marketplace. So where would we go? This is going to be the official paper trade. I'm actually going to go to the August 21st expiration. Right now, the VXN, which is the volatility index that tracks the Nasdaq, and also by default would be tracking the QQQs, which goes along with the Nasdaq index. It's the ETF that tracks it. Is one of the ETFs that tracks it, is trading at about a 30% implied volatility. Today, the VIX closed at around a 24%. That's the volatility index, the 30-day volatility index that tracks the SPX. So I gave you all the volatilities across the board. Amazon is around 40% on a 30-day basis going into earnings. Apple is around 30%, Google around 30%, Facebook around 37%. So this is a little bit less expensive, but obviously there's going to be a lot of different stocks that are involved. It could be very possible that Amazon goes through the roof, and Apple goes straight down the drain, right? And the QQQs are going to reflect that because they will have exposures to both of those stocks, all four of the stocks that are going to be announcing earnings. But you can pick any expiration you want. Obviously, go out further in time. That means you're a little bit nervous longer in time, and it's going to be more expensive overall. But I'm just going to go a little bit out of the money, about 1.5% out of the money. That's going to be about 5 points here. And we're going to look at the 255 strike put option. The 255 strike put option right now is trading on the ask price of $5.20. So that is $520 to protect your portfolio full of Nasdaq stocks against a downward movement in the marketplace. Now, I don't think that is outrageous. I don't think that's extremely expensive. And the way that I would look at it is, if I add up my stocks that I consider part of the QQQ, and you can go and easily find like the top 10 stocks in the QQQ that make it up and see what type of exposure that you have there. But overall, you're looking at spending about $520 to try to protect about $26,000 worth of market value. Now, if the market goes down 2 points in the QQQ after the earnings, well, this doesn't really help, right? Because you're looking at the 255 strike, and 2 points down from 260 would only be 258. So you're looking for a fairly decent sized move to the downside, and you're trying to use these options as protection against that movement. Now, I started by talking about using spreads, and you could do that if you would like to in the QQQ, but I kind of think that we are using the QQQ to lower the overall cost of the option contracts that we're buying. Now, we might have to buy a lot of them if you have, $100,000 worth of market value in these underlying stocks, and we're calling it 26,000. We could do the math fairly simple if you just kind of round it down to 25,000, because it's not an exact science anyways. So 25,000 goes into 100,000 4 times. So you'd be looking at buying about 4 puts to try to protect yourself against a downward movement in general of the Nasdaq based off of the earnings of these major companies overall and what might happen after those earnings. So I'll give you one last paper trade here. If you look, that would be the 255 August 20 calls, 23 days to expiration. The big earnings day is going to happen this Thursday. You got all day Friday for those option contracts to trade, but we're giving ourselves plenty of time for this to pay out. We're buying a little bit of time because time, if we're just buying puts outright, time doesn't hurt us that much, right? By having more time is okay. We still are going to have some fluctuations in implied volatility, but we are in that index, and it is trading fairly close to even where the VIX index is at, so it hasn't really spiked overall, even though we're going to have this big earnings thing that's going to happen this Thursday. So if you wanted to do the spread, I would be a little bit more cautious. I would actually go a little bit more near term. And the reason why is that if the market does go down on that spread, I don't really care if the market goes up. I should be benefiting from all the stocks that I own to the upside. So I'm going to reiterate, if I'm doing this type of trade, I'm still bullish on these stocks. I'm bullish but nervous about this big event that's going to happen. And I'm going to use the Qs to try to protect myself as opposed to paying the inflated premiums of all the individual stocks. And it's not going to be as good of a hedge. Just in general, it will not be as buying that underlying stock. But I'm going to try to do my best to determine how many puts that I would want to use. Now, if I was going to use a long put spread in the Qs, I would maybe look at the August 7th expiration. And the reason why is that if the market goes down, we would rather have us reach the short strike closer to the expiration date. So the August 7th expiration is actually 9 days away. And that greatly reduces the cost of the 255 strike put. So with 9 days remaining, the 255 strike put goes to $2.87 on the ask, $287 for that protection, but it's a shorter term protection overall. But then you could say to yourself, okay, from 255, I'm all right all the way down to about 240, maybe 235. So let's look at those prices. So if I go down to 240, which would be 15 points lower, the 240 is actually trading for 52 cents. I could sell it on the bid for 52. The ask is 56. Maybe I get 53 or 54 if I work the order a little bit. But I'm just bringing in about that amount of capital. And so if I'm going to pay $2.85, is that 50 cents? How important is that to me to lower the overall cost of the 255 strike put that's trading for $2.87? On a percentage basis, it's a fairly big percentage. But overall, you have to ask yourself, would do I want to give up the protection from 240 on down in the QQQs? Because that's what I'm doing. I am buying to ensure my position. Then I'm selling and I'm becoming an underwriter from 240 on down, right? I'm selling that put option as opposed to buying it. But I am getting paid for saying I'm going to give up any upside on my long 255 put from 240 on down. So those are just some solid ideas around this big event that's going to happen in the Nasdaq. We've talked a lot about different strategies that would be volatility plays like skip strike butterflies in Amazon and in Google and in Apple. We've looked at a lot of those type of strategies around earnings because in particular, Amazon always seems to announce on a Thursday. And that means you have one day for those expensive option contracts to live. So it makes it interesting to do trades like butterflies with only one day to live in that one weekly, that Friday expiration option contract. All right. Well, that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, check me out on Twitter. First of all, my handle is Brian Overby. Also, you can send me an email at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.